you're really bullish. What happens if we have lockdown after lockdown, even if it's regional in Europe, and if we get it here in the US?
Well, let's first just look at the following observation. Every single commodity market, with the exception of coffee, cocoa, and iron ore, are in a deficit right now. That's because the hit to supply has been massive, despite a wall of worry around demand right now. Now, I think one thing in terms of thinking about demand is that the COVID comes in waves. 1/3 of the world right now is coming out of their infection rates. Think about places like Melbourne and Australia, India, and places like that. It's improving, while another third is going in places like Europe and the US that are sinking deep. And then you have a group in the center that are one that moves around. So I think the key point here is much more supply is down substantially. Markets are all in deficit. By the way, that's something that typically happens at the end of the business cycle, not something just 6 months after hitting a trough of a recession. So we're in a very unique time period, and I'm not that worried about what's hitting 1/3 of the world, because another third of the world is coming out.
Okay, so Jeff, you're neutral near term, medium term overweight. What you're saying is that there is no shift to the right in terms of the timing as a result of, for instance, the COVID cases rising in Europe?
It definitely has an impact at the margin. But in terms of looking at all of these markets, let me go back and say it again. Every single one of them, but a few agriculture markets, are in a deficit, which just underscores the structural shift in supply that we have seen. In fact, there are three key themes that we're focused on and why we're so bullish as we look forward. One is structural underinvestment. Second is policy-driven demand. The third is a macro tailwind. So let's just quickly talk about the structural underinvestment. This is a theme that we've been talking about since 2017. We called it the revenge of the old economy. Basically, new economy soars, great returns over there, moves all the capital to the new economy, and starves the old economy of the capital it needs to grow. Overlay COVID crisis, particularly in oil when we saw negative prices on that, and then overlay ESG concerns, capital has been siphoned out of this sector. So that's point one. Point two, policy-driven demand. This is as big as the BRICS story back 20 years ago. We actually calculate the impact on copper demand because of infrastructure stimulus around the world is bigger than what with the impact that China had back in the early 2000s. And then finally, you have the macro tailwind of a weak dollar and inflationary concerns as we start to look out 2 or 3 years or beyond. So very robust backdrop for commodities right now.
Well, I'm glad you brought up the China situation, because you mentioned, 1/3 of the world and maybe under lockdown, but the other is going to be okay. And I was assuming that you were mentioning Asia, in particular China. But as China's outlining a new, 5-year plan here that looks to be they're going to go at themselves in certain industries, they still want to be an export powerhouse, but that has to have some kind of shift in the commodity market.
Well, if anything, when you start to look at what has happened over the course of the last, let's say, 6 to 12 months, China's share of global GDP has accelerated. So all the big commodity consumers, particularly in Asia, now occupy a bigger share of the overall pie of demand. Because think about the growth in Chinese economic activity because of the stimulus on infrastructure, construction, and other activities. This has had a big impact. By the way, when I say we're really bullish on commodities, I want to emphasize non-energy commodities like base metals, precious metals, bulks, we want to be long today. The energy, particularly oil, we think tactically you don't want to be long until after the winter because the demand hit has been so much larger there. By the way, gas, we want to be long today. So there's only one commodity, oil, that we would delay that bullish view. The rest of them, particularly given what's going on in China, we want to be long today, particularly copper.
Jeff, how long do I want to be long for? Is this a super cycle?
That is a really difficult question to answer. My straight up answer, this thing has legs till 2022. Now, when we start to talk about that second theme, which was policy driven demand, I like to point out, once you open up that Pandora's box, it's hard to put it back in because we start to talk about policy spending, and we're looking at policy going to lower incomes. This is the first time we see spending of this magnitude on that income group since the 1960s and 70s. And remember, LBJ opened up that one back in the mid 60s, and you didn't put it back in the box until Reagan, until 1981. I'm not forecasting we're going to see something like that. I just want to emphasize that once you start this process, it's very difficult to stop it.
What we do see, Jeff, is no matter what country you're in, it's the shift to green. That seems to be where a lot of that policy money is going, whether Europe, whether China, whether here in the U.S., if you get a President Biden win. Have you guys crunched the numbers to quantify that kind of demand based on the policies that are currently out there?
Oh, yes. When you start to look at copper demand, we're talking 600,000 tons year-over-year growth at the beginning, going to 1 million tons year-over-year growth. That's why I emphasize this is on the magnitude of the brick story back in the early 2000s. And I do want to emphasize all of these stories all funnel up into inflationary tail risk. Particularly when you start to think about climate change. We estimate that climate change will cost each American $4,000 per year till 2050. That's a family of four, that's $20,000 per year, which means they can't afford that. That means more stimulus, more spending by the government to start to address these issues. And that starts to increase the cost of everything, putting upward pressure on prices.
Jeff, governments want to make their economies carbon neutral. How, as an investor, do I make my portfolio carbon neutral? And when do you think I need to do it by?
We just put out a piece a week ago where we introduced our carbon neutral commodity index. The idea that we put forth there really is to buy the offsets. We thought, well, you can buy European, the carbon price there as an offset to your position. And we find out you take all the commodities within the Goldman Sachs commodity index. To offset that, you would need about 13.5%, carbon contracts. But that's not the only way you can do it. You can plant trees and do other activities. Well, that's the way we know how to do it now. Ultimately, I think it'll evolve very similar like the sulfur market, where you have green commodities like aluminum that was produced in a very green way, where we know it didn't have a carbon footprint, versus brown aluminum that does, that has that carbon footprint. We'll eventually evolve to a two market system. But right now, the best way to do it really is by doing offsets. Well, I'm on the side of the Atlantic.
All right, as we just settle up here, I'm really interested, Jeff, in your views of oil. You mentioned not yet to get bullish on oil. So I wonder how you look at the recent consolidation in the shale patch and then how that sets up oil in your bull market thesis.
Well, to really get productivity gains, what we need to see are the big majors involved in this activity. Unfortunately, their stock price has been hit hard following the COVID, which is why you see, much smaller, more E&Ps, Pioneer, WPX, Husky over the weekend. What we need to see to have a real impact on the cost structure of the industry is for some of the real big super majors, the Chevrons, the Exxons, the BP, Shells, the Totals, to get involved in this game. Because at this point right now, you're just creating super independence. We need to create something equivalent to what we did in the late 90s, where we created the super majors. That can start to have an impact on the cost structure. But we're moving in the right direction. Now, it's something that we forecasted and was really central to our commodity view a year ago. However, we really thought the majors would be involved in that, and that's still yet to be seen.